and welcome to slide pack 8 of the financial modeling program where we will be talking about the income statement. And what I will do here is dive straight into the income statement, and that's what we will go through. So what we have here is the income statement for Cisco Systems, which is part of the course project. As you can see, in cell A1, I've got the title which says Cisco Systems Income Statement. Next to that, I specify that all of the data here is in millions except per share data. Now, Cisco is a company that deals in billions of dollars. So to have a large number in the billions tends to get very difficult to follow and read. So the way they present their data is in millions, as you'll see here. Now, if you look down to the tab says I-S, which is my mnemonic for income statement. So anyone that's in my model can see that I'm currently on the income statement tab. And as you can see, this is an income statement for fiscal year 2006, which ended on the 29th of July 2006. And then I have the various historical numbers for the income statement. But let's talk about the line items in the income statement. So I'll use Cisco as an example. So Cisco makes its money by selling products in the networking space and by selling services. So they break out their revenue by product and service, and Cisco calls its revenue net sales. So the product net sales is 23917. Now, does that mean Cisco only sold $23,917 worth of product? It doesn't. What this number represents is 23,917 million, or $23.917 billion. So this is the product and the service net sales, and Cisco adds them up to give you your total net sales, which can also be called total revenue. It's up to you. Different companies have different ways in which they call this number. A lot of them just say revenue from product, revenue from service, total revenue. Cisco chooses to do net sales, and they may have business reasons for doing that. So once you've got your net sales, your total net sales is your top line revenue. This is the amount of revenue that the company generates. Not to be confused with the amount of cash that the company generates, because a lot of these sales are non-cash sales. These are sales where Cisco sells something and it'll give the person an invoice, and the invoice typically has payment terms like net 30 days or net 15 days or net 45 days, which basically means that payment has to be made 30 days after the product has been delivered and or installed, depending on the sales contract, at the customer's location. So Cisco doesn't see the money when it makes the sale, and the money might come in later, but the fact that the contract has been signed and that the product has been delivered allows Cisco, per GAAP accounting rules, to actually include the net sales number in here. Next, we go on to what's called the cost of sales. Now, the cost of sales, again, is divided systematically category by category. So Cisco has cost of sales for product and cost of sales for service. Now, just to give you a sense of what this cost of sales is, Cisco has a certain manufacturing cost associated with the products that it makes. This is the cost of the sheet metal, the cost of the various electronics that goes into the box, the cost of the software that goes into it, the cost perhaps of the shipping of the product from places such as manufacturing locations abroad to the US. So all of that is included in this cost of sales. And as you can see, Cisco is doing quite okay, where it has a total cost of sales on product for about 8 billion. It manages to sell these products for a total of close to about 24 billion, which is almost 3 times. Not bad. Likewise, it's got its cost of service, which appears to have roughly the same 1:3 ratio. The service is 1.63 billion, and the revenue that's generated from the service is about 4.5 billion. Now, the cost of service includes things like oftentimes Cisco might contract their service providers out to a small company that's serving a local area in, let's just say Oklahoma City or Sacramento or wherever, and Cisco will have to pay these people for going out there and installing Cisco equipment and things like that. So that is what makes up your cost of sales. And when you add up your product and service cost of sales, you get your total cost of sales. Now, your total net sales is $28.5 billion. I'm rounding numbers off. Your total cost of sales is $9.7 billion. When you subtract 9.7 from 28, you get 18.7. This number is called the gross profit, but Cisco prefers to use the term gross margin. Though strictly speaking, gross margin refers to a percentage of your total net sales. But if a company has a certain way they like to talk about it, we generally accept that and go on with it. Now, what Cisco also does here is it tells you that as a percentage of revenue, the gross profit was 65.8%. And it's good to record this number. And if you look at the formula, and I'll use Excel's F2 key so that you can see a color highlight here. It's the gross profit, which is in cell B14, $18.747 billion, divided by cell B8, which is the total net sales. The other thing I just want to quickly note here is that if you look at the dollar sign before 8 in B8, that is a way of making sure that this formula can be calculated in this column, and it's always going to refer back to cell to row 8. So that is the gross profit margin. Now, it's also good for a company to report gross profit margins because you can see the consistency or lack thereof of the gross profit margin from quarter to quarter or month to month or year to year. And it's a very good management tool because management gets a good sense of how they are doing or what's going wrong and how can gross margins be improved. And at the same time, it gives shareholders some visibility into what's happening with the business at an operational level or at a gross margin level. Cisco further breaks this down and says the gross profit as a percentage of revenue for products was 66%, slightly less for services at 64.5%, but in general, both these numbers are excellent numbers. Going down, it then breaks out its various operating expenses, and I'll just scroll up on this one. So Cisco has 5 categories that they break their operating expenses into. There's research and development or R&D, sales and marketing, general and administrative, which is often shortened and just called G&A. There's amortization, and there's in-process R&D. So these are all of Cisco's operating expenses. And then they total all their operating expenses up and tell you that they had total operating expenses of $11.7 billion. Now, I want you to understand these line items. So research and development is everything that Cisco spends on researching new products, developing new software, developing new services. This is their R&D bucket. Sales and marketing is the sales staff that Cisco has, the marketing people that Cisco has, the marketing programs that Cisco has, the sales conferences that Cisco employees attend to promote sales of their product and services. All of that is included in here. What is also included in here are the salaries of the people that are in the sales and marketing departments within the company, or the advertising expenses tied to the advertising agencies or the TV channels or the TV commercials that Cisco advertises with. So all of that is included in the sales and marketing bucket. G&A is typically staff overhead and facility overhead. So Cisco has these huge offices with thousands of employees. There's the cost of renting an office, or there's the cost of the electricity and the water, and there's the cost of the administrative staff. A lot of times the CEO's salary is part of G&A overhead. Top management is part of G&A and overhead. And it depends. Different companies break it down differently. So for example, the chief marketing officer might actually come under the sales and marketing budget item. And then Cisco's got a couple of other line items, and I will not go into detail on that, but different companies have different line items that are very typical of their business on an ongoing basis, which they like to include whenever they present their financial data consistently to their management and to their investors. So now, when you subtract out the total operating expenses from the gross margin, in fact, if you look at that formula, it subtracts total operating expenses in green from the gross margin in blue. That gives you your total operating income. And what Cisco does is it says that the operating income divided by the total net sales, and if you look at that $8 there, absolute references, that gives you the operating margin, which is 24.6%. Not bad at all. Just as a guideline, 24.6% is a fairly healthy operating margin to have. And then after that, Cisco says, we typically have some other income items and expenses. So Cisco has a large stash of money that they invest in various securities, bonds, and a lot of things that they invest in. And so they have this line item every year or every quarter or every month. That's the interest income from the earnings on the cash that they have invested. And companies like to invest their cash for a whole host of reasons. There's no point having billions of dollars sitting idle, because money loses value over time. You want that money to at least keep up with inflation, but ideally do much, much better. So with large companies with large hoards of cash, they have what's called a very active treasury department, which sits with the chief financial officer, and their job is to make sure that the company's money is always earning more money for the company, that it's not sitting idle. Sometimes companies take on debt. In this case, in that case, they've got to pay interest on the debt. So there's a line item for interest expense. As it happened in fiscal 2006, Cisco did not have any interest expenses, so this is a blank. And then they may have other income categories, and I'll give you one example of another income category. A lot of times, a company like Cisco might make a strategic investment in a company that it thinks it might acquire down the road, or with which it might want to partner for either products or services or software or whatever. And so let's just say it holds a 20% stake in some small company. Now that company might actually give Cisco dividends as a stakeholder that Cisco would then declare under this other income category. And then you add up all of your other income items and you get the interest and other income loss, which is $637 million. So as you can see, Cisco is actually doing pretty well. And then here you add the operating income and you add all of the other income and expenses, and you get your income before income taxes. This is your taxable income. And then based on what its accountants estimate, Cisco comes up with what's called a provision for income taxes and says we expect to pay roughly $2 billion in taxes. When you take out that 2 billion from the 7.633, you get a net income which is $5.5 billion, or a net margin of 19.6%, which is a very healthy margin. Now, Cisco is a publicly traded company, so there's some additional information that they present to their management and their shareholders. And in fact, this is a very key metric on how shares are valued in the market. This metric very simply is net income per share, which is also called the earnings per share. All it is it's the net income in row 40, which is $5.58 billion, divided by the total number of shares outstanding. Now, there are two measures for the total number of shares outstanding. One is the basic number of shares outstanding, and the other one is the diluted number of shares outstanding. And the diluted number is the more realistic number because it factors in things such as options that may have been granted that have not yet converted into shares but are very likely going to convert into share. So the diluted number gives you a more realistic sense of the number of shares that the company has or will have outstanding. And so in general, from a conservative accounting and modeling standpoint, the diluted EPS number is probably a safer number to go with, but companies like to present both, which is fine. So those are all the line items that are in the income statement, and we'll stop here on this slide pack and we'll move on to the balance sheet and the cash flow and other financial modeling concepts in subsequent slide packs. Thank you very much.